It is generally agreed that Warren Buffett is one of the most prosperous investors in history. In addition to his business success, Buffett is famous for his pleasant demeanor and investment quotes. There is a consensus that if you want to reach the peak of a financial mountain, you first need to stop digging your financial hole. Knowing how and when to stop digging is the first step to stopping the mentality and habits that keep you poor. And you can greatly improve your odds of earning money thanks to the vast knowledge of Warren Buffett. Let's look at 10 habits to avoid at all costs if you want to be wealthy. Number 1. Leaving your debts for tomorrow. Many consumers must pay exorbitant interest rates because of the current economic climate. They have yet to be able to put much money away since they don't know how to break the pattern. But to put it simply, you must pay your bills immediately. Create a strategy and follow it closely to stop spending on things you will forget in a matter of minutes. Warren Buffett is the greatest long-term investor in the world, and by long-term, we mean years and years of holding an asset before selling it. This goes against the short-term mindset that keeps you in a debt-exorbitant interest rate. Before making any purchases, Buffett analyzes his next move and doesn't rely on raw emotions. Once you control them, you will see how your finances start to be in excellent shape. 2. Stop updating your electronics. There's no way to stop this from happening. While it's always a good idea to invest in cutting-edge technology, it's not always the best use of your money to buy a brand new phone every time one comes out. Now is the time to take responsibility for your life. Now is the time to act. You must start making plans to improve your financial situation immediately, and that starts with delaying gratification. Wait a little bit longer for every financial purchase, and value the old gadgets that you have. Warren is one of the world's wealthiest men, yet he frequently dines at McDonald's rather than fine dining establishments. Sometimes there is something far more profound and less expensive than the latest gadgets that burn your credit card. 3. Never sell what you own. Buffett has said in many publications that he would purchase a firm with a 100-year lifespan and keep it forever if the price was right. There are two possible explanations. To begin with, it is impossible to predict the future share price increase accurately. Second, you must pay taxes on any capital gains you make when selling your shares. The first depends on luck, but the second doesn't. If you don't sell, you also avoid paying capital gains tax. Investors will want to buy shares if a company starts making more money. This may result from the company's efficient operations or increased pricing. 4. Showing off. Many people who are worried about their social status have the terrible habit of buying things to show off, rather than buying them for themselves because of their social status. That's a shortcut to brokehood, and there's nowhere around it. You will stay poor forever if you keep buying things to impress others. One should always shop to keep their new acquisition for a very long time. If you purchase a new phone every year and then sell your old phone to pay for it, you may be startled to hear that you are actually losing money. The same goes for valuable goods. Hold on to them a little longer, whether they are stocks or valuable assets. Remember that there are many hidden fees in every transaction, and swinging your assets around can make you lose more than you realize. Number 5. No budget on site. Most people overestimate how much they know about their own financial situation. While some may be able to make such a claim, the vast majority of us just can't. While we may be aware of our major outlays, the little ones typically harm our budgets the most. All your financial transactions should be recorded, no matter how large or small. You should have a much better grasp of financial management after reading this. 6. Practical and cheap is the way to go. Decide on one that fits your budget without sacrificing quality. In Poor Charlie's Almanac, Charlie Munger, the long-term partner of Warren Buffett, mentions that he has always irritated his children by making them take the bus instead of flying whenever possible. Charlie's children began speaking ill of him after he had already achieved great financial success. After achieving success as a lawyer, he shifted gears and established himself as a rich businessman. It is said that Warren Buffett's daughter persuaded him to give up his love of classic Cadillacs. After that, he bought a brand new car at a reasonable price. Spending money on items that will be utilized and valued, rather than shown off as a status symbol, is an example of frugality. You shouldn't purchase a Lamborghini if you need a working vehicle. Instead, Settle for a used Honda Accord. While any vehicle would do if your ultimate destination is within a few miles, the Accord will save you the most money throughout your journey. 7. Investing all or nothing. Some people take all of their money and dive right into the markets, all or nothing. That will keep you poor forever, since you are not investing, you are playing just like in the casino. Investing in a low-cost index fund is the way to go. And while most of Buffett's insights are more philosophical in nature, he has offered several useful recommendations that almost everyone can put into practice. The typical investor would do well to follow Buffett's suggestion and invest in index funds if they could afford it. In a letter to Berkshire Hathaway shareholders, he recommended they place 10% of the money in short-term government bonds and 90% in a very low-cost S&P 500 index fund. This is a position that Buffett has long held. Buffett said that when asked about his investment strategy, if you invested in a very low-cost index fund and didn't put all the money in at once, but averaged it over 10 years, you'd perform better than 90% of the individuals who started investing at the same time. This was discussed during Berkshire Hathaway's 2004 annual meeting. Number 8. There are no shortcuts to wealth. Don't dismiss your savings as useless. Instead, put them to work for you as long-term investments. As Buffett said, an old tree may provide shade for a person today since it was planted many years ago. If you invest the time and effort into planting the seeds of financial stability today, you can sit in its shade in the future. The difference between retiring comfortably and going into debt to send your kids to college might hinge on one nuance. Buffett takes a long view when it comes to investing. In a letter to shareholders, he urged them to consider the long term while making investments. As they progress in their investment careers, they should want to enhance their buying power dramatically. He assured them that the flow of the stock market and the uncertain state of the economy were nothing to be concerned about. The road to true riches and stability is long and winding, with many obstacles to overcome along the way. Remember that getting ahead financially is a never-ending struggle, no matter how difficult things may seem. A stable financial base is what you'll have with it. 9. Improvising with your finances. Establish a regular savings plan and stick to it. Having a financial safety net is another preventative measure you might take. Buffett was reported as stating, "We generally hold at least $20 billion and often a lot more than that in cash and cash equivalents," in Berkshire Hathaway's annual report. Both individuals and corporations strive to earn a profit from their investments. According to Buffett, cash is just as important as breathing for a company. You don't give it much thought while you have it, but it's all you can think about when you don't. 10. Never taking the time to study. Growing your knowledge of personal finance is an investment that will pay off in the long term. Limiting his risk exposure is an important part of Buffett's job as an investor. Risk is the result of incompetence. Improving your financial literacy can make you feel safer since you'll be less likely to take unwarranted risks. Warren Buffett's remark emphasizes the need to learn more about personal finance. Buffett's friend and business partner, Charlie Munger, famously advised him to go to bed wiser than when you wake up. Most individuals would rather avoid a difficult situation entirely if they could. Doing so is a certain way to cause long-term difficulties. That rule of thumb should likewise be applied to your money. Most individuals stress about how they'll provide for their immediate requirements while thinking that their long-term worries will be handled automatically. It's prudent to weigh many possibilities when selecting how to allocate funds. Though meeting immediate needs is essential, putting some money aside for later use is wise. What's your worst financial habit? Tell us in the comments section below. Leave a like and subscribe for more videos like this. Thanks for watching.